This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So the stock market continues to hit new highs. We can't complain about that, but that means it's getting a little more difficult to find the value and growth still dominates. So why fight what's going on, right? Let's not fight it. Let's find some value stocks that also have growth. And the best way to do that is through the PEG ratio. PEG is what it looks like if you're on any of the financial sites. You don't have to figure it out for yourself anymore. It's included right there along with the PE, the price to book, price to sales. You'll find the PEG, and it means the PE divided by the growth rate. Now, this little ratio was first enacted by Warren Buffett's mentor, Benjamin Graham, and it is a good way of finding stocks that either have low PEs and decent growth, or they may have high PEs, but the growth is so fantastic that it still appears to be cheap. So we're not going to argue against that either, are we? No. So when you see the PEG ratio sitting there, it will be a number. And what we want to look for to get the value plus the growth is a PEG ratio of 1 or less. So anything over 1 is not considered classic value, but I still look at anything under 2 to be extremely cheap. And it's hard still to even find stocks that are 2 and under right now, but those ones that are 1 and under means something pretty good is going on there. And it's probably on the growth side right now since we're in a growth market. So I went on the Zacks premium screens and I just ran the PEG ratio screen. And that's all it's called. It just says PEG. It doesn't even say PEG ratio. It just says PEG. It's under the value screens. Not surprising because it does look for both growth and value. And what it looks for is, of course, a PEG under 1. Not surprising. A close above $5, prior close, because we really don't want like the $2 stocks. And even though there's some that are good quality out there, especially even right now, but we're looking for 5 and above. And then it does have this other little feature in there that is the average of all broker recommendations. And it looks for 2.5 and under. So a 1 is the strong buy, a 5 is the sell. So the 3 is the hold. So it's looking for a little better than the 3, either the 1s or the 2s. Basically. And that's the average. So you may still have a few brokers that are giving it a 3, but there's going to be someone else in there that is a little more bullish. And then we do want to add the Zacks rank of number 1s, the strong buys, or the number 2s, which is the buys. So hopefully we are getting rising earnings estimates, but combined with that PEG under 1, again, means something pretty good is going on with that growth side of the component, the earnings growth. So running the screen, we got 17 stocks this time. And of course, I'm only going to talk about 3 of them. But what was in the screen? A lot of foreign companies, once again, especially in finance, some of the online payment companies, the foreign online payments, a video game company, foreign video games, a couple of banks are in there, but I'm going to avoid all those. And I'm going with U.S. companies, actually. And a couple of them we haven't talked about in a long time. So I was pleased to see that there's a few new type of stocks that are showing up on this type of screen, and that's why we ran it. So let's dive right in. Okay, the first one I did have to look up. It's a small cap. I had not heard of this one before, and it's in the AI side, so not surprising. That's where the growth is going to come from. And it's SKIL, ticker S as in Sam, K, I-L, SKIL. It's number 1. It's got the A for value on the style scores and AVGM, but it is small, market cap of 128 million. Not surprising that there would be a lot of smaller cap companies in this type of screen. We didn't screen for size at all. Forward PE of just 4.2. So that's very cheap. PEG ratio of 0.42. And what's going on with this company? So Skillsoft is, and I'm quoting what they say, the first AI native skills intelligence platform built for the human plus AI era. And I did notice that they were emphasizing throughout that it's both humans and AI, because it's a little controversial right now, right? About whether or not the human side might be excluded. So this is combining both. They are in a transformation. They have two different groups. So they're kind of in the HR side. Like it seems like what their product is sold a lot to HRs, but this transformation is going over to talent development solutions. And then they have global knowledge. And they are still talking in the last quarterly report that economic uncertainty continued into the second quarter. And they said that weighed on revenue. They had weaker discretionary demand for live trading, but they still achieved free cash flow in the last 12-month period and year to date now. So they were at negative earnings for several years. 2020, fiscal 2026, that's what they're in right now, expected to decline 19.6% on earnings. But we finally are getting, because we have the PE now, we finally are getting positive earnings. And it's really jumped since this last earnings report to $3.48 from a loss of $2.47 in just 30 days. One of the estimates is higher. That's how we're getting the number one rank. But they did make $4.33 last year, so that's why it's a decline of 19.6%. Next year, analysts even more bullish. One has been raised in the last 30 days for next fiscal year, looking at $5.15, and that's up from a loss of $3.70. So whatever this transformation thing is that they're doing appears to be working. They have launched their Skillsoft Percipio platform. This is an all-in-one platform to manage workforce capability. They claim it's more than an HR initiative. They are partnered with Salesforce as well. So all of this is going on, but this is what we've seen with a lot of companies with AI, and especially these that are trying to sell some kind of AI solution and products to the corporate world, basically. So it's a work in progress. I've already talked about how cheap it is. Sales this year expected to decline 2.8% and then be up just 0.75 next year. So must be a little bit higher margin business to be getting this type of turnaround in the earnings. The broker recommendation is at 2 for Skillsoft. So we don't have a lot of estimates. So that might even just be one analyst. Like I said, it's a very small cap company. They usually aren't going to have a lot of analyst coverage. So that is Skillsoft. It does have the growth and it's got the cheapness, but it looks like there's a lot of things going on. It's hard to get information with small cap companies. But this is one maybe to keep on your short list, keep watch on it. The shares have been pretty volatile, but kind of holding out in a narrow trading range between $12.50 and $16.50 for the last couple of months. So we're really probably going to need a small cap rally, even bigger than what is happening right now. Small caps are busting out to new highs, but they're not really having the momentum of the large caps right now, even with that bust out. So we really would need a bigger small cap bust out. But if you're looking for an AI play on the small cap side, Skillsoft should be on your watch list. That's ticker SKIL. Okay, getting out of there, we're going to return to names most of us know. And the second stock is Pinterest, ticker P as in Paul, I, N as in Nancy, S. I know many of you think Pinterest hasn't that been left for dead, but no, it is among the more popular apps for younger people. That is under age 20. They love Pinterest. Pinterest even had to recently change their notification algorithm because it was notifying students while they were in school and it was a big distraction. So between the hours of, I think it's 7 and 3 p.m., they have been muting notifications to, under 18 users of the app. But Pinterest always been a matter of, are they growing their user base? And then are they able to grow the global average revenue? Now, AI is also in play with Pinterest because they're really using the AI tools on the advertising side now, and also to not necessarily show the images or videos that are showing up in Pinterest, because many of those do now say AI created or something with AI on those, but those are some on the site. But they're really using it for shopping features. So if you really like a certain couch or paint color, and that's what your Pinterest board is, it can use the tools in AI to generate advertising for you so you can go out and buy a product that looks similar to the one that you're looking at. So this is really driving their revenue, and overall global average revenue per user jumped to $1.74 from $1.64 in the second quarter. US was at $7.29 from $6.85. Europe at $1.30 versus $1.03. Rest of the world was at 19 cents versus 13 cents. The advertising just isn't really there for the rest of the world outside of the US and Europe. I think the US might have Canada stuck in there too. I'm not sure though, or they're stuck in Europe. I'm not sure on where Canada falls in there, but I'm assuming that that average revenue is higher for the Canadians as well. Monthly active users have also been jumping, but mostly out of growth everywhere else in the world. The US has remained steady for over the last 10 years. They did get a little boost during the pandemic, but there's always just been this very steady group that's been on it. And right now in the second quarter, it was at 102 million. That's up from 98 million a year ago. But it's always just kind of been between 95 and 105 for a long time. But Europe's still getting the growth. They're at 146 million active users versus 136 million a year ago, and rest of the world at 329 million now versus 288 million. If only they can monetize that group of people, right? Revenue jumped to 998 million from 854 a year ago. Most of it was in the US, 745 million of it. Europe was at 191 million, but rest of the world was still at also, no, that's not right. Not at 100. It looks too similar than it is similar. Let me see. Revenue, rest of the world, 63 million, up from 38 million. I had doubled the Europe. I'm like, that can't be right. But again, think of if we could get rest of the world to that 191 from 63, then you're really talking. But it's still the US, one of the richest countries in the world, and that's where the advertising is, that's where the consumer is, and that's where they're really making most of their money. But you still got to like the direction it's all going in, and that's why I like Pinterest right here. What is happening with the cheapness on Pinterest? So we know it's got a peg under 1, and it is at 0.54 right now. Forward PE is a little more expensive, and certainly more expensive than Skillsoft at 18.2. So how did we get a peg under 1 then? We had pretty good earnings growth, and taking a look, we do. Earnings growth for 2025 expected to be up 33%. And then another 22% expected for next year. So that's why you've got that growthy component, just like with Skillsoft, but even more consistently. It's been doing double digits earnings growth since 2023. 2022 was a bad year, like a lot of the tech companies, also sell-offs in 2022 when the Fed started raising interest rates, but it has righted the ship and it's seeing some good gains now. And the street has noticed, but not completely, as the shares aren't really doing much right now. But we'll see on this next earnings report, because the shares seem to get a boost when everyone remembers, oh yeah, Pinterest, they're doing pretty well. On the sales side, sales expected to be up 15.8% this year, 14.2% next year. That's all real solid with a PE of just 18 and that PEG of 0.5. So I'm liking Pinterest. I own it in Zacks Value Investor portfolio. We've owned it for a couple of months now. So we will see on this next earnings report, but the shares have come down off of the August highs. Could be a buying opportunity for those interested, but this is another one I'd keep on my watch list. So Pinterest, PINS. And then the third one is one we have talked about off and on over the years. It's been a while, though. It's very cyclical. So many times it shows up as a cheap stock when it's really running. And right now it is really running on the growth side. So the PE is having a hard time keeping up with that growth side. Then we get the low peg, and it is Micron. Micron Technologies, ticker M as in Mary U. It's the Zacks #1 rank. It just reported earnings. It is on that fiscal year, and it had record-breaking fiscal year for fiscal 2025. Had all-time highs across the data center business, no surprise, but cloud is looking good. All of its divisions were looking good, and you can't really argue at all about what that quarter was like. Now, they still see momentum continuing into Q1 of 2025. How cheap is it? So PEG ratio is 0.39. That's very cheap. Forward PE of 11.2. But it's got the super high growth because, again, record all-time highs across the data center business. Earnings expected to be up in fiscal 2026, 100%. And then 2027, 12%. It was up 537% for 2025, that record-breaking year. So they're not kidding when they're talking about a surge in the earnings. They are memory and storage, remember, but this is an AI play as well. In fiscal 2026, sales expected to be up 42% to $53 billion from $37.38 billion last year, which was a record year. So I'm assuming, obviously, this will be another record year. And then it's too far into the future to know 2027, but another 14.8% expected on the sales side for 2027. But we'll see. In a couple of quarters, we'll be getting a better idea about that. But again, Micron, very cyclical, like the semiconductors. There's a surges in business, and then it will like collapse down. So right now we're in a surge. And so the stock always looks a lot cheaper when you get this big earnings growth. But we are looking for both value and growth. This is on the tech side. It's on the AI. Actually, all three of these are AI stocks. I didn't really think of that when I was picking them, but they really all have an AI component that is driving that growth side of the equation, and they still remain relatively cheap. Now, whether that lasts real long, again, nobody knows, but for right now, in October of 2025, they all have the low pegs under 1, so they've got the growth, and they're relatively cheap on the other valuations, the classic value. So that's Micron, ticker MU. So Pinterest, did I say it was a #2 buy? That's a #2 right now. Micron has all of its estimates are higher after that last earnings report, which was a blockbuster. And just to give you some idea, The Zacks consensus for fiscal 2026 before they reported was at $13.05, and now it's at $16.58. That's how much bullish the company actually was on its guidance. So that is telling you a lot. So this is what we want as value investors. We want to get that growth. You're going to have some more risk to get the growth right now. And that risk is in AI. Who will be the winners? Who will not be the winners remains to be seen. And so you can still get into this trade early on, and we're still fairly early on. But eventually we will separate out the winners and the losers in even AI. That's why I want to get them cheap. And with some of these, you can. So let me recap the stocks again. We had Skillsoft. This is the kind of HR platform type of company, very small cap. It did have negative earnings expected. Now it's positive. We'll see what happens. But small caps, always a little riskier. And ticker is S as in Sam, K-I-L, S-K-I-L for that one. Pinterest is P as in Paul, I-N-S. And it also is leveraging AI for higher revenue there. And Micron, ticker M as in Mary, U, memory and storage. And this is the time you want to be in that business. On a side note, the average broker rating for Micron is now 1.46. So that's closer to the strong buys. So more of those brokers are, having the higher recommendation on the stock. Pinterest broker recommendation was 1.35. That's even higher than Micron. So a lot of the analysts very bullish on Pinterest there too. And those brokerages are with the stronger sell recommendation or stronger buys, recommendations for Pinterest. So be sure to keep running these screens because things are changing quickly. We're going to be in earnings season now here in October. So a lot of these estimates are going to change and there's going to be some surprises. Like I feel like Micron's earnings a couple of weeks ago were a surprise to the overall market, and the analysts are a little behind on these AI plays. Will they be behind on even more this earnings season? I guess I might have to run this screen, in a couple of weeks to see what else is going to be on it. But be sure to do so. This was a Zacks premium screen. Again, you have to be a premium member to get it, but you can get our basic screens for free on Zacks.com. Just go to the screening bar. It's up at the top, the screening button, and it says it'll bust out all your options, and it says there is a premium screen on there, but you can also click on just Stock Screener, and it will take you to like how you can run your own. If you click on the predefined button, that's also on the little green part next to the help button, and then it'll tell you basic and premium. So the basic, anyone can get in. And so you use some of those. There's some interesting screens there as well. So as always, you should subscribe to get all of our podcasts. I know many of you are over on YouTube now. So listen on YouTube. We're at Zacks Podcast there. It's not on our normal podcast channel. It's just Zacks Podcast. But we're also on Apple, Spotify, Amazon Music. Just about anywhere you can find podcasts, you can get The Value Investor there. And be sure to do so because next week I'll be back with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.